Now I want to talk about completing the DCF. And if you remember last time, we had, which is now a week ago, taken a look at the cash flow of Walmart. We looked at the unlevered free cash flow from Walmart. That's going to pop up in a second. And we discounted that back to present value. It gave us an implied value of $60 billion. But again, this is just for the first X years of the cash flow. And then we found two ways to come up with the terminal value of the business that would help us get a complete value of Walmart. One is using the EBITDA method, and the EBITDA method is taking the last year's EBITDA and applying a multiple. What multiple? Well, for now, to be conservative, we back calculated into what their current trading multiple is. Right? We took their enterprise value divided by current EBITDA, and the implication is, well, in 5 years, let's assume that their multiple is not going to change. If their multiple doesn't change, even if EBITDA is growing, the company should be worth more. That's the idea. You know, knowing this type of industry now, that multiple could be declining. That's another. But we'll look at comps. We'll look at comps to justify that. That gave us $224 billion. And then we took the second method, which is the perpetuity method. The perpetuity method is taking the unlevered free cash flow, using the perpetuity mathematical series formula, which is multiplying this by 1 plus G, dividing by WACC minus G. That gave us $114 billion. Very different. And in theory, the perpetuity method should fall in line with the EBITDA method. It should. If not, something is off, and I know something's off. The WACC, this discount rate is way too high for a company like this. Walmart is very, very large. Their volatility is relatively low. That should be impacted by WACC. So what does that mean? That's what I want to talk about today. We did not talk about the weighted average cost of capital. So what is the weighted average cost of capital, first of all? Who can explain that to me? What's the purpose of the weighted average cost of capital? What's its use? A lot of first round investment banking interview questions on this. Nick.
Alex, if you want to. I was just going to say it's basically the breakdown of who they're essentially going to owe money to.
Yep.
Based on their capital structure.
Exactly.
So,
yeah. No, that's perfect. So the weighted average cost of capital helps determine what the expected return should be to investors in each type of security. And to the company, when you're projecting cash flows, those cash flows need to be discounted to present value by that rate, because that's the expected monies that need to be returned to those investors. So there's debt investors and there's equity investors, mostly. And you weight that. So, you know, and then it's abbreviated as the WACC. In its simplest form is the debt portion of the business, so debt divided by debt plus equity. It's the weight, it's the debt proportion of the business, times the cost of debt, plus the equity component of the business times the cost of equity. So if the debt on the business has an interest rate of 5%, that means lenders, the investors, have to get paid 5% each year. That's the cost of debt, 5%. That's their cost of debt. Effectively the interest rate. It gets more complicated with public tradable debts, but generally that's what that is. As an equity investor, you're expected a certain percentage of return. That's the cost of equity. And so we weight that. So cost of debt times how much debt's on your business versus cost of equity times how much equity is on your business. The one thing is, to the cost of debt, we just add a 1 minus tax deductible percentage, because interest is tax deductible. That's the general formula for the weighted average cost of capital. It's the returns of each security weighted by the amount of that security on your business. Right? And this could be expanded right, if you have other types of securities, although in modeling as analysts you usually don't go beyond this. So if you had preferred securities, you could do, let's say we have three types of debt. We have debt, equity, and you have preferreds. Well, then it's the debt portion of every, so debt divided by debt plus equity plus preferreds times cost of debt. Equity divided by debt plus equity plus preferreds times cost of equity. And then the preferred portion times debt plus equity plus preferreds times cost of preferreds. I mean, we'll look at Heinz, the acquisition of Heinz, where Warren Buffett invests, and his investment, a portion of it is a preferred security, and he's expecting a 9% return. It's just stated 9%, or was it 8%? I forgot, but it was stated a certain percent was going to be paid to him as a dividend. That's his cost of preferred. And so technically, if you really want to get into as much detail as possible for each type of security, you'd have a term like this, where you'd weight that times the expected return on that security. But generally, when we do the WACC formula, when people talk about it, and most importantly in interviews, it's usually just debt and equity. Just combine debt and equity. Very simple. We keep it simple. It's tough in valuation. You get into all this theoretical investment science for just a wide range of valuation. It's easy to over-engineer this stuff. So the cost of debt, and one last thing is, in order for this to be current, it's important to use current debt and current equity levels. So you can look at book value of equity, or you can look at market value of equity. And sometimes by default, especially if the company is private, you'll look at the book values of this stuff. But if you can get the market values of this stuff, it's better to get the market values of this stuff. I'll show you what I mean when we do this for Walmart. So the cost of debt is pretty much simply the interest rate times 1 minus the tax rate. What's the cost of equity? How do we calculate the cost of equity?
Capital asset pricing model.
The capital asset pricing model. And what is the capital asset pricing model?
Essentially, your market risk premium multiplied by the company's beta, which is like the correlation between.
Okay, but no, but just that's a specific capital asset pricing model. Just generally, what are capital asset pricing models? Or what are ways? Let's just step back for a second. What are ways to determine the cost of equity?
Comparing the risk of this enterprise to risk-free investments.
Yeah. So right. So the point of, and we talked about this a little bit last week. The point of the cost of equity is to determine the rate of return of a specific investment commensurate to the risk of that investment, right? Which means what?
The higher the risk, higher the return.
The higher the risk, the expected higher the return. So the capital asset pricing model is a theory of pricing the value of a security based on the risk involved. And some people believe in that and some people don't believe in that. What are other ways to determine the cost of equity? I'm going to erase this and move on. There are other pricing models to determine the cost of expected return. Anyone know? There's a dividend discount model, right? Your returns are based on the expected payout, dividend payouts of stocks. Right? The payouts of stocks will predict what the future value of the stock will be, or the future return on the stock. It's another way. There's several different models out there, but the most common is the one that Alex mentioned. I just want to step back for a second. Is the capital asset pricing model, and it's important to understand generally where it comes from because it'll help you with interviews, and it'll also help you understand really how to pull in the proper data and to think about what it means. And so the idea of the capital asset pricing model is every security has some sort of return and some sort of risk. Is that risk? I keep forgetting. Or is this risk? This is risk, right?
Yeah.
The second one? Risk. Should have risk, right? And in any investment market, there's generally some base risk-free rate of return. In other words, in the US, I can invest in Treasury securities. What are we at now, Treasuries? 2.43%? Or it swings a little bit. Just for the sake of the example, let's just simplify 2%. There's a risk-free rate of return, meaning I, as an investor, can make an investment and receive a 2% return with zero risk. Almost zero risk, right? There are some markets in other countries where there is no risk-free rate of return, or the risk-free rate of return is zero, right? But let's take this example. So there's some base risk-free rate of return. And so an investor is going to say, well, why would I invest in any other security, something here, that can have greater risk, right? This is risk, with the same return. Why would I ever do that? I would never take greater risk to get 2% back. I would never do that. I would rather stay here safe and guarantee a 2%. But an investor would say, well, I will take greater risk. I'll take that chance if at least on a 1-to-1 ratio, my return would be greater. Right? I'll take that chance. I'll take a 1% greater risk for a potential 1% greater return, or at least I'd like to have that choice. I don't have to take that option. I could just go back here, but I'd only consider that option if there is an expected equivalent rate of return that's commensurate to that risk. And I would never, on this basis, if there is a 3% return with a 1% additional level of risk, I would never invest in something that has the same return that has more risk than that. I would never. It makes no sense. Why would I invest in this security? There's no potential of greater return. I would just stay here. Right? The safest place possible to get that return. And that'll continue. If there is something with greater risk, I would consider it only if there's an equivalently greater return. Right? So that's another percent. And so the theory goes that this line should kind of go up and extrapolate, right? This is where all rational investments should be on this line. Because if there's any type of investment here with additional risk, this just means there's an investment out there with the same risk, with the same return but less risk. So rational investors would never ever, right, invest under that line for that reason. It would never make sense. Why would anyone ever do that? This is all riskier investments with equivalent returns that you can get by investing on that line. Right? That's the starting point of the capital asset pricing model. Now, what about up here? So if there was something up here, let's say Treasury rates increase, or let's say there was a new investment, doesn't have to be Treasury bonds, that was zero risk and a higher return. Well, if that's the case, then no investor would invest in this anymore. They would only invest in something that's riskier than that if there was a 1% increase in return, and so on. So then there would be a line like this. So the point is, if there was some sort of better type of investments out there with better returns and with less risk, then all investors would gravitate towards a new line. But that doesn't exist. If that did exist, then there's only the possibility of one line to exist where all investors would gravitate towards. So if there were new investments out there that were up in here, then a whole new line would be drawn. That's the idea. But that doesn't exist consistently enough. Right now, in reality, obviously there are investments in all areas, all across the board. But you hope that the law of averages is most investors would gravitate towards this line. And that makes sense. That's the starting point. So you can pick points in the line and identify what those investments are. And so, for example, let's say that this is the S&P 500, S&P 50, right? Which is an average composite of 500 stocks. And the average rate of return of the S&P 500 is, on average, between 8 and 12%. So are we okay here? Yeah, let's just say 10% on average as a random example. And so if that's where the S&P 500 should hover, then the components of the S&P 500 should be within some radius of the S&P 500. That's the idea. So all Walmart, IBM, all the components of the S&P 500 has to, since it's a composite of the index, has to kind of hover around here. So imagine 500 dots in this shaded area. So the point is, we're going to find some way to identify which one of these dots is Walmart. And that would be our expected return in Walmart in relation to the risk. That's the idea. Well, how do we do that? Well, first what we do is we look at the difference between the expected return of the market and the risk-free rate. Just the premium. What's the premium of the return on the market? And that's also called the market risk premium. Don't confuse market risk premium with return on the market. The market risk premium is the return on the market minus the risk rate. It's just the premium, right? And we calculate what that is. We just look at the historical returns, 10%, 12%, 15%, whatever it currently has been at. And what we do is we look at the historical returns of the S&P 500 and we relate it to the historical returns of Walmart. And we look at how in the past Walmart has moved with the S&P 500. If the S&P 500 has jumped 10%, did Walmart jump 10% or did Walmart jump 5%? If Walmart has historically reduced 10%, has the S&P 500 reduced 5% as well, or has it gone up 5%? So we correlate the returns of the stocks over the past 10 years, 20 years, 30 years, 100 years of Walmart versus the S&P 500. And that gives us a correlation coefficient. And that correlation coefficient is called beta. Beta is roughly a measure of how well one set of stocks track with another. If beta is 1, and let's say we calculated beta as the beta of Walmart versus the S&P 500, if it's 1, that means they're trading in line. If Walmart increases by 10, if S&P 500 increases by 10%, then Walmart would increase by 10%. If the beta is 0.5, that kind of means if S&P 500 increases by 10%, Walmart increases by 0.5%, less volatile than the market. If beta was -1, then it's the opposite. If S&P 500 increases by 10%, Walmart could decrease by 10%. So we multiply this coefficient by the market risk premium. We take the market risk premium and we multiply it by the beta. And that gives us an understanding as to, based on the historical returns of the market, how much should Walmart trade in line with the market. Now this gives us just the premium, right? Because the risk-free rate has been removed. This is risk-free return on the market minus risk-free rate. That's just the premium. That's just this gap. Where is Walmart in this gap? So at the end we need to add back the risk-free rate, and that should be our entire return, right? So you can reword this as the risk-free rate plus the market risk premium, or the return of the market, minus the risk-free rate times the beta. And that's the cost of equity. That's the idea of what the cost of equity should be. And that's the basic reason why. And the reason why it's important to understand, I think that's all you need to know. That's all you need to know about CAPM. That's all you need to know for interviews. That's all you need to know for what's important to know is when you think about Walmart, where are the major variables here? Now, obviously, this is all very variable, but in terms of digging up data and resources, well, the risk-free rate in the U.S. is more likely the U.S. Treasury. If you're looking at a company that's, let's say, in Germany, the risk-free rate's going to be very different, right? So you need to look at that. The market risk premium, or the return on the market, depends on what index is the stock they're analyzing a composite of. You can't always use the S&P 500. If you're looking at a company that's in a different index, it's on the NASDAQ or in a different country. You have to look at what the historical return is based on the return of that company's markets. So you'll be asked questions around this. Or when you're doing models on your transactions and stuff, you've got to make sure that you have the right framework. And the beta, you need to be careful and make sure that the beta is based on the stock within that market that the company is in, and you want to consider time frame. A lot of questions around there, out there about calculating the CAPM, calculating the cost of equity, what the time frame is. In timing, you just have to be consistent. If you're using a 30-year risk-free rate, you want a 30-year beta, you want a 30-year return on the market. Very simple. If you have a 10-year risk-free rate, you want a 10-year beta, you want a 10-year return on the market. If you have a choice, well, you could do a 10-year cost of equity or a 30-year cost of equity. There's two sides to that point. Just if you're asked that in an interview, usually you're asked in interviews about consistency within the time frame. But if you're asked if you had a choice, pick a point and pick a stance and defend it. The argument for wanting a short-term cost of equity is that your DCF really is only modeled out for 5 or 7 years. So that's where people say, so I'd rather just have a short-term cost of equity, short-term discount rate. My thought is, it is modeled out for 5 years, but the whole model should be in perpetuity. So I believe a more longer-term perspective, so I always use 30-year data. But there's two sides to that, and I can argue with both sides of that. But so the point is, when calculating the weighted average cost of capital, first you got to think about the cost of equity. You got to get the risk-free rate. You got to look up the treasury rates. Got to get the market risk premium. I'll show you how to do that. There's some online resources that can give you market risk premium. You need to calculate the beta. You can look up the beta on Yahoo Finance. If you really want to get into downloading your own stock prices and calculating your own beta, you can do that. If it's really difficult to get betas, I'll show you how to do that later in the program. For now, I would just look it up. That's the cost of equity. The cost of debt is the interest rates on the debts, and then you weight the average. That's how you do that. So let's take a break. I want to do this for Walmart.